Hello, student. I, Dr. Shafari Jain, Assistant Professor, Tirthankar Mahaveer University. Student, today we discuss about the accounting cost block 5th. In the previous video, we also discussed about the explicit cost, implicit cost, fixed cost, and variable cost. Today, we discuss about the accounting cost. Accounting costs are those costs that a firm incurs. These costs are explicit cost. There is an actual expenditure which is kept in records for future reference. An accounting cost is defined as follows. An accounting cost is the actual expenditure incurred by the producer during businesses. These expenses also have a written record. It means accounting cost can be defined as the cost of activity as recorded because during business producer during business uh, have a written record. Uh, this is called accounting cost because accounting costs are tangible costs comprising business fundamentals payroll, payroll, production cost, and marketing budgets. Accounting costs are recorded in the business ledger so that they appear in its financial statement. So, accounting costs measure the monetary value of taking an action. They are the explicit cost involved with the business. For example, if a company wants to open a satellite office in a new market, they must make investment such as new hires, computer equipment, software systems, rent, and inventory. If the total spend on all these areas is 7 lakh, then that is the accounting cost. So we can see accounting cost are sometimes refers to as hard cost. They are easily tracked and include in amount in typically areas such as payroll, equipment, productions, and others. So, as I also discuss you that accounting costs are explicit cost, also referred as hard cost that include business necessities like payroll, productions cost, marketing budgets. Business can easily track explicit cost because they include a specific amount. You can dollar amount. Recording cost include anything a business spends. Yeah, you can say specific rupees amount. You can see both according to the country. Accounting cost include anything a business spend and you deduct them from revenues in an accounting period. This means accounting costs are real money that leaves the bank each accounting period and includes everything you spend to market, manufacture, and delivers products. You are required to determine accounting cost before you can calculate the accounting profit. For example, suppose business plans on the opening a store front in a new market. It may first decide to make investment, including hiring new employees, new computer software and equipments, credit inventory, and rent. If the total amount spent on these features is suppose 40 lakh, that's a total accounting cost. Additional examples of accounting cost may be include as raw materials and equipments, utilities and maintenance, rent, and to calculate accounting cost, you can add all business expenses together, such as manufacturing cost, labor, salaries, taxes, rent. So you can say uh, The formula for calculating accounting cost is manufacturing cost plus labor, salaries, and taxes plus facility cost plus any additional expenses. Uh, all the total of is called the accounting cost. So it's also say here that accounting cost is equal to in which we include manufacturing cost, labor, salaries, and taxes, facility cost, and any additional expenses. So uh, now some steps can be followed to calculate accounting cost as first of all, determine materials and manufacturing cost. Some accounting cost expenses are the cost of raw material and the manufacturing cost required to turn the raw material into a product. Manufacturing cost overhead may include the cost of electricity, property taxes, and insurance for the manufacturing equipment. This also includes the salaries of manufacturers and production line employees as well as. With it, in accounting cost, it calculate labor, salaries, and taxes. Besides the salaries of people involved in the manufacturing, include the salaries of other employees. Calculating total payroll expenses helps determine the total accounting cost. Besides payroll, consider any payroll taxes and potential fees to figure out the total expenses of the paying employees. With that, determining cost for the facility. You have to calculate it or the labor cost and employee salaries. You can move on the cost of the facility, paying rent, and can be considerable business expenses, including the cost of rent, insurance, and utilities when calculating the accounting cost. And with it, we are also including any additional cost help guarantee that you are calculating the total accounting cost. Additional expenses may include marketing and advertising or office suppliers. The goal of calculating the accounting cost is to know exactly how much you are spending on projected to spend. So it is important to include all business expenses. With it, add all accounting expenses. To calculate the accounting cost, add up all of the total business expenses, including manufacturing, uh, payroll, rent, and any other expense that arises. For example, suppose the projected profit is 1 lakh and the projected expenses including employee salaries, rent, insurance, utilities, office suppliers and other expenses total is suppose 45,000. In case the accounting cost profit is 55,000 and the cost uh, accounting cost are 45,000. So hope you have understood what is the accounting cost. Here are I have also uh, the uses of the accounting cost show the expenditures incurred on production of the commodity which considered for pricing strategy. I have also explained it in the detail. It also helps in calculating profit. With the example, I have also explained it and it has in decision making. So, in short, we can say accounting costs are expenses that are the cost from by firm production. Therefore, all the payments that are made by our company to its suppliers and other clients come under the accounting cost. Accounting costs are also known as explicit cost. I have also discussed it. These include rent, utility bills, interest payment, etc. These costs are actually direct costs that are associated with the business accounting cost are accounted for each expense made and then recorded in the ledgers or accounting software. I think, Strand, you have to understood what is the accounting cost. Now we discuss about the economic cost. Economic cost are those costs that an entrepreneur incurs while conducting economic activities. For an entrepreneur, an economic activity in his business. Therefore, economic costs include all the direct and indirect that the entrepreneur incurs while conducting business. And economic cost is the summations of explicit cost and implicit cost. And economic cost is defined as follows. And economic cost is the combination of direct and indirect cost that are incurred by the firms to produce commodities. It means economic cost is usually used for comparing two separate courses of action. It helps in the evaluations process of a particular action for a business. The costs are calculated based on the accounting cost, or also subtracting implicit cost. So, uh, economic cost, also known as opportunity cost. Look at the potential differences between taking one action over another. They measure both the explicit cost and the implicit cost of the following strategy. In example, a company spent suppose 7 lakh rupees, yeah, to open a new satellite office at location A. But they opened a satellite office at location B, they bought the office location but leased it another company. They did not open the new office but instead put more money into the main location. So the total of the accounting cost plus the difference in the cost between choosing other option instead of option A is the economic cost. Economic cost include both the explicit and implicit cost of an action. As I also take another examples, if a company has an asset, an average an orange grow, for example, and uses an economic cost analysis to determine if it would be better to maintain and harvest the orange grove or lease. It is another company to do the work. Finding the differences in cost between the two options is the benefit of using an economic cost analysis. Economic costs are important um, for determining long range business strategies. For accountants who work in this area, softwares in increase important to determine the tool economic cost of of different options. Economic costs are critically to determining if there are lost opportunities for revenue that organizations miss by choosing one strategy over another. It is as at its simplest level, it is a way to determining how to use a company's cash and resources to create the biggest profit. While accounting costs are crucial to tracking hard costs for a business, while economic costs are vital to determine the best future direction for an organization. I hope, student, you well understood what is the economic cost. And now we discuss uses of economic cost issues, the expenditure incurred on production of the commodity, which is considered for pricing strategy. I have also discussed it in the examples. It also helps in calculating profits. It has in decision making. It has written again. It has to ascertain opportunity cost and it directly impacted profitability to of the. So calculating economic cost uh, can help us determining which strategic option to pursue by companies' alternative cost against the accounting cost. To calculate economic cost, take the total accounting cost and add or subtract the monetary value of choosing an alternative options. Here are some steps to calculate economic cost. As First of all, calculate the accounting cost using the formula for calculating accounting cost. Determine the total amount of expenses you currently have. Consider all aspects of design, labor, manufacturing, production, and distribution. Adding up all business expenses allows you to determine how much you are currently spending versus the amount of to profit you are rendering. And with it, calculating the implicit cost. Once you have calculated the explicit cost, you can calculate the implicit cost, or the cost that an alternative options would yield. Perhaps is an alternative option you would only need three store managers versus six, affecting the total labor cost. Alternatively, the business options you are considering may include entering a new market, in which case you can add up all potential business expenses and investment involved in this process. And with it, you can calculate economic cost to find out which bring business options is the right choice. To calculate the economic cost, subtract the projected implicit cost from the predetermined accounting cost. With this calculation, you may determine if an alternative business option could save the company money. This may help to you decide whether to pursue an alternative business venture. So, I think you have understood well what is accounting cost and what is economic cost. Now, we discuss about the differences between accounting cost and economic cost. So, now, first of all, accounting cost, meaning and accounting cost is the actual cost incurred. I have also discussed it that it is the actual cost. Economic cost is the direct or an indirect cost, in which we add explicit and implicit cost. Nature is direct or explicit cost. Accounting cost is a direct or explicit cost, while economic cost it is direct as well as indirect cost. And in it, uh, we add explicit and implicit cost both. Now, importance. It is useful for financial reporting and tax purposes. I have also discussed it about while economic cost is useful for managerial decision making purposes, and accounting cost is equal to explicit cost, while economic cost is equal to explicit cost plus implicit cost. And uh, in the profit evaluation, accounting cost evaluation helps to find accounting profit. Accounting profit is equal to total revenue minus explicit cost, while economic cost evaluation helps to find economic profit. I have also discussed it in the video. So economic cost is equal to total revenue minus total cost. So user accounting cost is used by an accounting, while economic cost is used by an economics too. So we can say both cost can help understand the financial situations of a business, and you may use accounting and economic cost at a different times. While accounting cost measure the monetary value of an action like payroll or utilities, economic cost considers the potential difference between one action versus another. You can use accounting cost to determine the total expenses and compare this to the overall gross profit. Accounting cost allow you to understand how much the company is spending versus how much profits it's making. While economic cost can allow you to determine if an alternative option yield a higher profit to minimize spending in particular areas. You can use economic cost when deciding between two different business approaches, allowing you to decide which choice is the best for the company. Considering alternative option can give you a more complete financial picture than relying on the accounting cost alone. So you can say accounting costs are essential to any business. Every business owner must know the exact amount of money coming in and going out. Accounting costs are reported on official company ledger. Economic costs are important for determining long-range business strategy. For accountant who works in this area, software is increasingly important to determine the total economic cost of different options. Economic costs are uh, critical to determining if there are there are lost opportunities for revenue that organization miss by choosing one strategy over another. So, Strand, hope you well understood what is the accounting cost and what is the economic cost. Now we discuss about the opportunity cost. Opportunity cost and opportunity cost is the opportunity or choice that is let go of or sacrificed for an alternative choice. In economics, opportunity cost is the foregone production factors in the business for an alternative production factors. So, opportunity cost, in the simple words, opportunity cost represent the potential benefits that a business and inventors or an individual consumers misses out on when choosing one alternative over another. While opportunity cost can be predicted with total certainty, taking them into consideration can lead to better decision making. So we can say that opportunity cost is the foregone benefits that would have been derived from an option other than the one that was chosen. To properly evaluate these costs, the cost and benefits of every option available must be considered and weighted against the other. Considering potential opportunity cost can guide individuals and organizations to more profitable decision making. This cost of a lost benefit is a strictly internal measure used for strategic planning. It is not included in accounting profit or reflected in external financial reporting. Example of opportunity cost consideration including investing in new manufacturing plants and the company deciding to upgrade company equipment or hire additional workers or buying stocks um, and opportunity cost you can say uh, opportunity cost in terms of our returns profit and investing by the using of material. So we can say that opportunity cost is a concept in economics that is defined as those values or benefits that are lost by a business owners or organizations when they choose one option or an alternative option over another option in the course of making business decisions. In simple words, it can be said as the value that is lost when a business is choosing between two or more alternatives. From an investor's perspective, opportunity cost will always mean that the investment choices made will be carrying immediate loss or gain in the future. Opportunity cost can be viewed as a trade off. Trade off happens in the decision making when one option is chosen over another option. Opportunity cost, sum of the total for that trade-off. For example, a certain kind of bamboo can be used to produce both paper and furniture. If the business takes a decision to consider using bamboo for furniture, then the society has to forego the number of bamboo that could have been used for manufacturing papers. So, opportunity cost is the best alternative choice. Here, the opportunity cost for producing furniture in the number of papers that are forego. So, opportunity cost of product is the best alternative that was forego. And there cannot be any other alternative. Opportunity cost can be calculated using the formula opportunity cost is equal to return on investment for an option not chosen and minus return on investment for a chosen option. There are some limitations of the opportunity cost also. The following, first of all, sorry, now the uses of opportunity cost helps in optimal utilization of the business resources because it is the alternative uses. So help in decision making, help with cost control. So, but there are some limitations also opportunity cost as future returns cannot be predicted accurately using opportunity cost, and it is difficult to make quantitative comparison between two available alternative. So this conclude the topic of opportunity cost, which is an important topic. It is a very important and has a uh, good place in the economics and commerce students. Now we discuss about what I student hope you have understood well what is the opportunity cost. Now we discuss about the difference between opportunity cost and economic cost. Some of the significant differences between opportunity cost and economic cost are follows. First of all, opportunity cost. Opportunity cost is the potential benefit that an individual or an entity losses by choosing one alternative over the other. I have also discussed it in my video. Now, economic cost. Economic cost looks at the overall profits or losses of choosing one alternative over the other in terms of resources, time, and cost. And if we see the scope, opportunity cost has a narrower scope since it is a part of the overall economic cost, while economic cost has a broader scope since it include the opportunity cost. Now, accounting cost, opportunity opportunity cost doesn't include the accounting cost of not choosing a particular alternative, and economic cost include the accounting cost of not choosing a particular alternative. Um, sorry, economic cost include and opportunity cost does not include. An example, if a group of peoples are building a school, the opportunity cost would be the money they could have made by carrying out some other economic activities. And example, economic cost, it is a group of people are building a school. The economic cost would be the total accounting cost. It is explicit or building as a bell, and the opportunity cost, the money they could have made by carrying out some other economic activity. So we can say an economic cost is the cost that varies with the level of output, while an opportunity cost is the money spent implementing a decision, and an economic cost is the cost of what you give up doing when you committed to the course of action you choose, while an opportunity cost is the money spent implementing a decision. And an economic cost is the cost that can be completely attributed to the productions of specific goods or service, while an opportunity cost is the money spent implementing a decision. And an opportunity cost is a cost that varies with the level of output, while an economic cost is the money spending implementation decision. So, Strand, today I discuss about what is economic cost, what is accounting cost, what is opportunity cost, what is the difference between accounting and economic cost, and what is the difference between economic and opportunity cost. Hope you well understood all the video now. Thank you. Thank you very much.